Welcome back to Financial Fundamentals, where we break down money concepts so they actually make sense. Today, we are talking about something a lot of people in their 30s feel but rarely say out loud. You log into your 401k account, you see the number. Maybe it went down, maybe it looks way smaller than you expected, and a little voice in your head goes, "Am I doing this right? Am I already behind? Should I be worried?" If that sounds familiar, you are in exactly the right place. By the end of this video, you are going to understand what your 401k actually is, why the anxiety around it is normal, and most importantly, what actually matters when you are 30 years old and thinking about retirement. Let's get into it. First, let's just talk about why this matters so much. Because I know retirement feels far away when you are 30. You have got rent, maybe a car payment, groceries that somehow keep getting more expensive, and retirement feels like something you deal with later. I get it. But here's the thing, the decisions you make right now at 30 have more impact on your future than almost any decision you will make at 45 or 55. Not because you have more money right now, but because you have something even more valuable. You have time, and in the world of money, time is everything. So let's start at the beginning. What even is a 401k? A 401k is a retirement savings account that is tied to your job. Your employer offers it, and you put money in from each paycheck before taxes are taken out. That last part matters, and we will come back to it. The name 401k is just the section of the tax code that created it. You do not need to remember that. What you do need to remember is this. It is an account specifically designed to help you save for retirement over a long period of time. Think of it like a special bucket. You put money in the bucket, the money inside the bucket gets to grow, and you are not supposed to touch it until you retire. Pretty straightforward. Now here is where a lot of people get confused. A 401k is not an investment by itself. It is the bucket. What goes inside the bucket, that is where your actual money gets invested. Usually in things like stock funds or bond funds, but most 401k plans make this pretty easy, which we will talk about in a minute. Okay, so let's talk about the thing that makes a 401k special for people who have access to one through their job, and that is the employer match. Here's what that means in plain English. Your employer says, hey, if you put money in your 401k, we will add some money on top of it. For free, it is literally part of your compensation that you only get if you participate. Here's a common example. Let's say your employer matches 50% of what you contribute, up to 6% of your salary. That sounds like a lot of words. Let me break it down. You earn $60,000 a year. 6% of $60,000 is $3,600. So if you put $3,600 into your 401k this year, your employer adds 50% of that on top. That is another $1,800. Just for participating. You put in $3,600, they add $1,800, and now $7,800 went into your retirement account this year. Not $5,400, $7,800. That $1,800 is not a loan. You do not pay it back. It is yours. It is part of what they are paying you, but you only get it if you show up for it. So if your employer offers a match and you are not contributing enough to get all of it, that is money you are leaving on the table every single paycheck. And I do not want that for you. All right, let's just pause for a second. So far, we have covered what a 401k is, why it is tied to your job, and why the employer match is such a big deal. Does that make sense? Good. Let's keep going. Now let's talk about the thing that is probably making you nervous in the first place. You check your account, and the number went down, maybe a lot, and it feels terrible. I understand that feeling completely, but I want you to hear this clearly. A drop in your 401k balance during a rough market is what we call a paper loss. Paper loss just means the number on your screen went down, but you have not actually lost anything yet. Not for real, because you have not sold anything. Think about it like this. Imagine you bought a pair of sneakers for $200. A week later, someone tells you they are only worth $150 right now. Did you lose $50? Not unless you sell them. If you hold on to them, the value can go back up. And historically, over long periods of time, the market has gone back up. That does not mean it always will, and nobody can promise you anything about the future. But the pattern over many decades has been recovery followed by growth. And here is the thing that people do not talk about enough. When the market goes down and you keep contributing to your 401k, you are actually buying more shares of those funds at a lower price. This is called dollar cost averaging. Do not let the name scare you. All it means is this. You invest the same amount regularly, no matter what the market is doing. So when prices are low, your money buys more. When prices are high, it buys less. Over time, this smooths things out. Think of it like buying coffee. If your usual coffee is $5 and one week it is on sale for $3, and you buy it anyway, you got a better deal. You did not panic and stop drinking coffee because the price changed. You just kept buying. That is what you are doing with your 401k contributions every month. Now I want to talk about something that quietly eats into your money over the years without you even noticing. Fees. Every investment fund inside your 401k charges a small annual fee called an expense ratio. That is just the percentage of your money the fund keeps every year to cover its costs. And it sounds tiny, like 0.5% or 1%, but over 35 years, that difference is enormous. Let me put a dollar amount on it. If you have $100,000 growing over 20 years, the difference between a 0.5% fee and a 1% fee can be tens of thousands of dollars. Not because of anything the market did, just because of fees. So when you look at your 401k options, look for the expense ratio. Lower is almost always better for funds that are similar. This is one of those quiet details that has a loud long-term impact. Now let me show you what consistent contributions can actually look like over time. This is an illustrative example, not a prediction of what will happen. But I want you to see the numbers. Let's say you are 30 years old. You earn $60,000 a year, and you contribute 10% of your salary to your 401k. That is $6,000 a year from you. Your employer matches 50% on up to 6%, so they add another $1,800. Total going in per year is $7,800. Now let's say your investments grow at an average of 7% per year over 35 years. 7% is just the hypothetical rate we are using for this example. By the time you are 65, that account could have grown to around $1.08 million. From $7,800 a year. That is the power of time and consistency working together. Now here's the part that really sticks with me. What if that same person got scared during a market dip at 30 and stopped contributing for 5 years? Just stopped, sat on the sidelines, waited for things to feel safer. Those 5 years of missing contributions, using the same assumptions, could mean hundreds of thousands of dollars less at retirement. Not because the market crashed and never came back, but because they were not in the game during those years. Consistency, even in scary times, often matters more than anything else. That is the takeaway from that example. Okay, before we wrap up, I want to mention something that makes all of this a lot less overwhelming. Inside most 401k plans, there is an option called a target date fund. Here's what that is in plain English. It is a single fund that basically runs itself. You pick the year you expect to retire, say a fund called something like Target Date 2055, and it automatically manages how your money is spread between stocks and bonds as you get older. When you are young, it leans heavier on stocks because you have time to ride out the ups and downs. As you get closer to retirement, it slowly shifts toward more stable stuff. You do not have to do anything. It adjusts over time on its own. For someone who does not want to manage this themselves, it is a totally reasonable starting point. One quick note on contribution limits, because this comes up a lot. The IRS sets a limit on how much you can put into your 401k each year. For 2024, that limit is $23,000. If you are 50 or older, you can add an extra $7,500. These numbers adjust over time, so always check the current year's IRS limit. Most people in their 30s are not hitting the max anyway, and that is completely fine. The goal is not to max it out. The goal is to contribute consistently and at minimum get the full employer match if one is available to you. All right, before we close out, think about this for a second. What is one thing from today that surprised you or that you did not know before? Maybe it was the paper loss idea. Maybe it was how much the employer match adds up. Whatever it was, hold on to that. That is your starting point. Here is the one thing I want you to walk away with today. At 30 years old, your biggest advantage is not how much money you have right now. It is how much time you have ahead of you. Staying consistent, capturing the employer match, keeping an eye on fees, and not panicking when the market drops. That is the framework. That is how this works. You do not have to be perfect. You just have to stay in the game. If this video helped you see your 401k a little differently, hit the like button. It genuinely helps this channel reach more people who need to hear this stuff. And if you know someone in their 20s or 30s who has been nervous about this topic, share it with them. This is exactly what Financial Fundamentals is here for. Making this stuff clear, calm, and actually useful. And if there is a money concept you have always been confused about, drop it in the comments. We go through every comment, and your question might become the next video. This video is for educational purposes only and is not financial advice. Markets and investments carry risk, including the possible loss of principal. Always do your own research and consult a licensed financial professional before making investment, tax, or money decisions.